Hoping you can all see it. It should all be, you should all be able to see it. This is actually cable. That dropped quite substantially, actually. Went below this kind of support zone, 158.20. Also probably being driven a bit by that move higher in euro sterling. Let's just take a look. Because there's been so much data out, I'm going to be giving just a brief overview of things that have just been happening just literally this morning. We've had some quite important data. Oh, let me just get that down. We've had some quite important data out. So as you can see, yes, that move lower in the pound could actually be driven by this shoot higher in euro sterling, right above that 86 zone. Now, I really did think that the euro would probably trade sideways a little bit more ahead of that payrolls report in the US. However, not to be, right? So we've had a huge move higher in euro sterling, and that really has helped or really put pressure on the pound generally. So what we're seeing now is that we've moved into 86.50, a very significant level. You know, to get to, oh goodness, what am I doing? I don't need, my apologies, sorry, I wasn't expecting that. One moment. It seems like Bloomberg is playing tricks on me there. But as you can see, you know, sharp move high. This is just an hourly chart, so just in the last hour. So again, since that PMI data. Now, one thing I would say that we are noticing is that combined with stronger economic data, and if you saw me, you can see that I kind of put that in quotation marks, and signs that there's, you know, the stance of the ECB, which is certainly not in loosening mode. This is all potent stuff for the currency, and it really, really is. I mean, you know, when it becomes a problem is when it starts weighing on growth. That's the biggest issue here. Now, as you can see, running into a bit of resistance as we get to 139. Well, sorry, as we get to 86.50, but a really nice move higher there. Starting to look overbought as well. However, what we've seen in the part, or throughout most of this rally actually, is that euro sterling has looked overbought based on some of the momentum indicators, but that really hasn't stopped this rally going forward. I mean, momentum indicators, they can be useful. They're a bit of a lagging indicator, and they're not always the best signal to use when we've got real momentum and real flow. Those of you who were at that Forex trading conference in London yesterday will know I did speak about CFTC data as being a really key key thing for the euro. You know, you got to trade what the market mindset is, not necessarily what your own gut feeling is. But from a fundamental perspective, we could argue that this is very good news. So really, you know, we're getting into, you know, multi-month highs here. We're all the way back to kind of 2011. So, you know, year and a quarter, whatever. Running the next real support zone, you could say, oh, apologies, let me just get that out of the way. Sorry, my instant message from Bloomberg. I pressed it by mistake, and they're very attentive, so they got back to me straight away. But yes, so going back to euro sterling, as you can see, quite a bit. I would say that's probably going to be a resistance zone here, a level where people are going to come in, and maybe not there, maybe even here. So this really opens the way to that 90 zone, but there is quite a lot of stickiness on the way up. So, you know, from really 88 all the way up to kind of 90, I would say is going to be, that's going to be a supply zone for sure, I would say, whereby people could potentially come in. I mean, you know, it is a multi-month high for sure. You know, back in 08, we were kind of at 95. So in that sense, we have been moving, you know, we're still quite a way to go. But obviously the big moves that we've had just in the last kind of this week even in euro have been quite astounding. What tends to happen in rallies is that you have a very initial move higher, and then very powerful kick higher. And, oh, sorry, my apologies. Great, they've come off. You have a very powerful move higher, and then things can slow down a bit. So we would say that something similar could be on the cards for euro here. There is also a lot we do also have, there is also. Obviously, there are event risks for the Eurozone. Of course, there's the potential for another flare-up in sovereign concerns. Right now, that's not what the market's thinking. That doesn't concern the market. It seems like the key thing really is it's really, the focus is really on the stabilisation, the continued stabilisation. We've had banking results from the currency bloc, from Spain in particular. They're paying back their LTRO data, and it seems like we're out of that phase, and we reached it in the US in about kind of 2010, late 2010 and over 2011, when the toxic stuff comes out, and you can almost see a clearing. You can see kind of a clearing where the bad debts are going. Now, bad debts have risen, or bad loan provisions, they certainly risen, but I think if anything that's probably a confidence boost to the markets, purely because it suggests that there's a little bit more realism there, and it suggests they've got a better grip on the overall problem. If we combine that with some better economic data, then that could be what drives us another leg higher. Now, sterling, in the UK, we had some slightly weaker than expected PMI data this morning. Not that much, it's still above 50. The Eurozones isn't above 50, but the Eurozones is expanding and was at its highest level since February 2012, so in 11 months. And that's what the market's reacting to. It's reacting to kind of the relative stances, also the relative stances of the central banks. And when yields are coming a bit more into play, we know that the euro has been very, very sensitive to yields, especially kind of that recovery in the interbank lending market. What with those LTRO lows being paid off. Good news in the kind of the financial sector is really helping to push up the euro. We've been waiting for the economic side of things to be pushed up as well, to provide a boost as well. And we are seeing some tentative signs. I would say that drop in the unemployment rate is really, really key. And I just want to check something for you guys. I just want to check how Italian, I know it's probably not going to be the easiest thing for you guys to see, Italian unemployment, well, that was at 11.2, so that was as expected, not any worse. But it does suggest that maybe we are making a little bit of headway, just a little bit of progress as we start this year. And remember, Draghi's been very clear that the second half of this year is when the eurozone will recover. So if that starts, we need to see that start now. And if that can pick up, then Draghi will go down in history as the guy that saved the eurozone, I suppose. But what does that mean for you guys? It's a difficult one, right? Do you want to buy here? We've seen the move already, so probably not. You'd probably want to buy, especially as we lead up to payrolls, I would probably say if you don't have a position already, keep out of it. If you've got a long-term position, then as I said, make sure that you're aware of that supply zone around between 88 and 90. But if you're not in yet, then there's always opportunity to come back in. If you're a shorter term trader, and move back towards let me go back. Sorry, just go back slightly. Back towards that kind of 86 mark could be a good entry point. A lot of today's move, especially as it's payrolls and there's US economic data, we've seen euro sterling really lead the way in euro and cable rates today. Let's go back to our euro chart, because this is where we're going to really see that data. We are kind of running into some resistance here now, looking like a temporary double top, 136.75. So we would probably wait for a pullback. We think it's going to trade sideways. I personally would wait until the payrolls number is released, the dust has been settled. What we've seen the last few months, especially in January, the data can be very, very difficult to read. When that happens, you get a lot of whips or price action. The other thing I would just point out on the euro, as you can see here, really nice move higher, really been kind of trending nicely higher, quite bullish signals. The bearish Harami pattern that was detected from earlier this week. So it was a long bullish engulfing candle, or where is it? It's probably on the daily, actually. Let me go back to that. It's this one here, this pattern here, that you can see. That tends to be a bearish sign. It suggests that sentiment is waning. Well, that hasn't been the case so far, right? So remember, patterns can go against us. They can give us kind of sometimes false signals, because since then the market really has been all gangbusters for the euro. Obviously, we've got to be cautious. We all know that, but I think this pattern is invalidated now. well. The other thing that I would also point out is that we have got payrolls that can be quite whipsawy. We have, the US, the Euro story is still playing high. We think it could have a bit further to go. Again, you've got to look at that positioning data. That's going to be quite positive. We're also going to be looking at, all the other things. Oh, sorry. Let me just go back. We're also going to be looking at, let me just load that again. We've also been looking, oh, that's yen, let me go back to euro. You've also got to think about next week. Next week, of course, I believe, yes, we should have the ECB meeting as well for the first ECB meeting of the year. But hang on a minute, let me just get that up. Next Thursday we've got ECB and we've got Bank of England. All of that is going to be obviously going to be important as a bit of an event risk. Central banks really are driving things. It'll be interesting to hear what Draghi says about this increase in rates and whether or not there's a problem there in terms of if he's worried that rates are going too high, if they're worried about the euro going too high. Remember that's going to be an event risk coming up, and you always have to be aware of the risks. But right now it does look quite good. Probably better off as wait until after the data. As we meant at the top, payrolls come out 1:30. That's what that's the big event today. Let's face it. However, we have had these huge moves in euro. That was worth talking about. So let's just look at a setup potentially for post the payrolls data. We have 165 is the aggregate. Is what the market's looking for. So that's the expectation on the street. If 165 is good, it's a bit of a pickup. If we were to get a bit higher than that, our in-house prop model's looking for 175, so slightly higher. We could see a bit of a firming in the dollar. That could push euro dollar back down below 136.50. Very good support, 136.20, 30. Just this zone in here. In the short term, again, people are probably going to use this to pick up some more euro, especially because next week we could just reinforce that theory that the Fed is going to be quite weak, is going to be quite hawkish relative to other central banks. Euro positive, of course. There seems to be certainly a demand in the market to get back up towards that 140 level. As you can see, here is a supply zone, a bit of a double top here, 142 now, but we think 140 is probably going to be a stretch too far. The power within this move suggests to me that people are piling into the euro whenever there's good news. If we see it's going to be important to gauge the reaction today. If we see a better than expected number from the eurozone, from the NFPs in the US. Let's go back to our short-term chart. And for example, we were to see the dollar firm. If from here, we're currently trading 136.60, we were to drop below 136, say to 135.50. Look there, those lows here, and then close the week at that level. That's still, we've still had very good gains on the week, and it would be a good entry point for a lot of people. Now, if we were to just have a very short move and close the week above 136, that would even be better. That would be even better. It would really suggest that the market isn't willing the bulls have control at the moment. It's always about the balance of buyers and sellers. It's the buyers who have control at the moment. There's limited downside. A lot of people are piling in. People are frightened to miss this move. That sometimes can be where the market gets overextended. I don't think we're there yet, but the closer we get to 140, we will be. But there could be another leg of this rally, and that's kind of what we've seen already. But do watch out for that. Now, if we get 200 plus payrolls data, that would be when I'd expect us to kind of maybe get below 135.50 and see a big move in the dollar. But remember, now this sometimes sounds complicated, but it's quite an interesting one, really. The FX market is quite it moves based on kind of fractions and where money is going relative to some currency. So if we see, say for example, a huge number that blows the expectations out of the water, 200 plus, say 200,000 plus, we could see a sharp jump higher in dollar yen. And what would that do? That would weaken the yen on a broad-based basis, which would also help push up euro yen, which would then help protect euro, dollar on the downside. So we don't see at the moment, we think there could certainly be a pullback. We'd use that as an entry to get long. If it holds above 136, good entry point. Otherwise 136.50 we think would hold very well, or maybe even 136.40. That would probably be the better option between 136.35 and 40, just below their 100-hour moving average. Good support zone. If we were to get a very weak number, that would weaken the dollar, and we could get, we could certainly make an attempt at 137. Again, that's not what the market is expecting. That would be probably the biggest shock. January numbers can be funny, so we would expect a bit of whipsaw action, and if it comes around, say 165, 180, there's no change in the unemployment rate, none of this kind of, hundreds of thousands of people leaving the workforce or whatever else that makes this number even harder to read, then we think we'll whipsaw a little bit as the market goes one direction, another direction, but overall we could end up kind of flat-ish where we are today. And right now we've had a real, like this week, we've had such a bullish, we've really, people have pushed into the euro. There's real bullish demand there. I think it could be some people being a bit concerned about missing this rally, and also people kind of maybe worried about joining the party a bit late. Someone's just asked about what effect does NFPs have on other crosses like Kiwi Pound. I will talk about that in a moment. I just want to take a quick look at US dollar, because when you think of NFPs, you've got to think of US dollar. You've got to think of dollar yen, and that's your first port of call. As you can see, 92. We've had this big move lower in the yen overnight, and that's on the back of some very weak economic data out of Japan, which supports what the government and the Bank of Japan are trying to do. 90.25 is, it's a significant level. We're starting to turn a little bit, moving into slightly overbought territory there, and looking very much overbought on a longer term basis. But as I said, the market is quite willing to put that to one side. And if we were to see, just bear with me one moment, if we were to see, a very good number, then we would expect this to push. This will be the dollar yen has proved itself to be very, very sensitive to economic data. It's just been very sensitive. It's been sensitive on the downside, or the yen has been sensitive on the downside to the weaker Japanese data. Now we're passing the baton to the US. So above 92.05, that suggests that kind of momentum very much to the upside. Right now 92.45 looking like a good resistance level, and then kind of 92.70. With 92 at the moment being a short-term strong support level. So there's a bit of congestion. Once we pushed above there, it's really made such a difference. And as we said, there's not too much in the way of resistance now between here and 94. Let's go all the way back to our weekly chart. As you can see, what a nice move higher. That really is. It suggests the bulls really are in control. Just looking at price action alone, it does suggest that kind of, a move back towards this kind of 94.50 level, back to this kind of supply zone, could be on the card. That doesn't mean that the rally would end there, but it could be where some people either take profits, or where some people will look to, or where, it could be an area really to think about, whereby some people will take profits. So use it to, some people use that as a good entry point then to, on a sell-off anyway, to move higher. Obviously, we've had such a fantastic run. A pullback would be completely normal, especially at the beginning. But because today's payrolls day, we wouldn't say that the pullback is going to be really dependent, or the future move is going to be really dependent on what this number is. Dollar yen as well moves very closely with payrolls. With treasury yields. Just bear with me one moment. I'm going to bring you up that chart. Here we go. Let me just do that. So as you can see, this is 10-year treasury yields, which is the orange line on the chart, and the yellow line is dollar yen. Move very, very closely together. Peaks and troughs tend to be at the same time. Right now we've broken up, so we're well above that 2% level, broke above that kind of, yes, we've still moved higher, interesting enough, in treasury yields, even though the data has been fairly weak. So there's some resting expectation of better data, even though I kind of find it hard to believe. We've even had the Fed come out and say that they're going to keep pumping money into the economy. We had very weak consumer confidence data, very weak GDP. If we get weak payrolls, be careful. This could turn around very, very quickly. I know that's not kind of our central scenario, but it is a possibility always. We do think that treasury yields will be capped. Probably around, potentially around about that kind of 220, maybe 240 zone, that high back from March. But people are really, this move isn't on that. This move higher in treasury yields above 2% isn't really being fueled by what's going on in the economic data in the US. We think it's more of that rotation out of bonds into stocks. So I'll look at stocks in a moment, but someone's waited very patiently for me to talk about Kiwi sterling. Hang on a minute, how do you do it? No, do sterling Kiwi. That's how it goes. So as you can see, really, really, really weak at one of its lowest levels. This break kind of around here, so kind of a move, like a move below kind of 188 is a very, very, very bearish development. This is a key level. We're going to probably oscillate around here, but at the moment what we've seen is a more hawkish RBNZ compared to the Bank of England. Obviously, when you're at these quite kind of levels to the downside that are quite stretched, we're going to need a real push from the bears to get us below that level. As I said, next week we do have the Bank of England. That could be the kind of fundamental driver that you need. Otherwise, from the Kiwi side of things, we do have very important data coming out next week on Wednesday the 6th, which is the employment data for Q4 from New Zealand. That is going to be so important. We're going to see, it's going to be really important to look at that very, very closely. That could be the driver. If that picks up in any way, then we could really see the Kiwi strengthen, combined with, say, maybe some dovish or negative data out of the UK. That could be what pushes us lower. Just looking at it on a more shorter term basis, though, what to do. As you can see, yes, we have been down around about kind of that 187.50 level. Currently kind of back up, retesting that 188. That should act, we think, as fairly good support. But there is good support at 187.50, which for now is certainly a temporary bottom. And it may just kind of meander sideways a little bit into payrolls. If we were to get a strong payrolls report, what would that do? Well, we think it could be negative the pound, which could boost, which could weaken Kiwi or sterling Kiwi even further. 189 there looks like fairly good support. Right now, we're still kind of trading that range. We're in the middle of it, but we are looking weak. The pound is very weak. It's shown itself. Let's just go back to that GBP data. The thing is, when you trade, say, across like sterling Kiwi, it will be kind of a relative play on the RBNZ versus the Bank of England, but it does get moved around an awful lot by other crosses, like the bigger, more widely traded sterling crosses and the more widely traded Kiwi crosses, like obviously against the dollar mostly, and euro sterling as well for the pound. So you do have to be aware of what's going on elsewhere. Is there any correlation with NFPs? Do you mean, someone's just asked that question, the same person, Jem, has asked that question. Do you mean correlation particularly with sterling Kiwi? No. The correlation is really with dollar yen. That's where the bulk of the move is, and it makes perfect sense for that to be the case. Dollar yen has a very strong relationship with dollar yen has a very strong relationship with treasury yields. Treasury yields are very sensitive to the employment reports, and that is the correlation. I just did show you that chart, so I won't go through it again. But basically, I think with that, a weak number would probably see payrolls fall, would cause dollar yen maybe to decline. Let's just bring up that dollar yen chart again. Could potentially cause dollar yen to get back towards that maybe 190, 150 level, maybe even to 91. That would still be, a fairly good move on the week. Likewise, a very strong number could really get us here now, 92.50 on our way to 94. Someone just asked, did we cover euro dollar already? We did. I'm happy, Black Cat, to go and have a quick look at euro. Again, just really quickly, as I said, you know, there's a lot of bullishness in the market. I'm not going to spend a lot of time on it. I did talk it, but basically, it seems to me like the bulk of things are bullish there. If we get a very strong payrolls number, then we could see some consolidation, profit taking on this, with dollar strengthening a little bit down to 136.30, maybe even back down to 136. Someone's just asked about the Aussie dollar. I'm definitely going to talk about the Aussie dollar now. That has been really interesting. That break below 104, in my mind, opens the way for a sharper move. That's below the 200-day moving average now. We could get back down to 101.5, so 101.50, which was the low from October. The Aussie has been sold off. It's been moving very much with the yen. So if you think that the yen is going to continue to do badly, then you should see then that would also move closely with Aussie. Aussie now has a good close relationship with dollar yen. The other thing I would point out is that Aussie, let's just go back here. So Aussie was your ultimate carry trade, right? We just had very weak employment data out of Australia overnight. Next week we have an RBA meeting. That RBA meeting, there is now a higher chance of a rate cut at that RBA meeting. So what we've really seen, one of the other reasons why we've seen this sharp fall off in the Aussie, and the Aussie not moving as you would expect, so not moving with stocks, not moving with better than expected Chinese data, is that it was a carry trade, right? But, and it still is a higher yielding currency than the euro, than the pound, than the dollar. However, it's more about expectations. You know, the euro, the ECB, the Bank of England, and the Fed, they don't have room to cut anymore, but the RBA do, and they may well choose to use that. What we could see instead is a real decline. Well, in that sense, what we've seen is this kind of carry trade. The euro, all of a sudden, it's doing well. The outlook is brighter. So people who were using the euro as a funding currency, they're now coming out of that, and that's really hitting Euro Aussie, because Euro Aussie, this is a daily chart. I know it's a bit of a skewed chart, but basically from kind of, for such a long time, this is Euro Aussie. For such a long time, let's go back to that daily chart, sorry. We've seen that fall so sharply for the first half of 2012. That's carry trade. So that was the euro weakening sharply against the Aussie, going from, 130 all the way down kind of below towards 115. Big move. Since then, we've moved higher again. And again, there could still be further to go. I mean, it's always worth looking at the different time frames to see where we are. So with Aussie, now that move below the 200-day moving average, I'll just bring that chart back up. That move below kind of 103.70-ish, which is where we're testing now, 200-day moving average. If we close below there on the week, very, very bearish, could open the way to 101.5, as I said. But good to see that some of you were at the conference there. I know I met some of you there. Always good to see you. Thank you so much for coming. Thanks for listening to my presentations as well, and thanks for saying that you enjoyed them. I hope they were helpful. Please, if you've got, I possibly have time for one more question. If there is not any, euro yen, someone said. Yes, I'll quickly go through euro yen. I think a lot of people are into that. I did look at it. Obviously, again, it's been one of the key beneficiaries today from that very weak data coming out of the US. 126 is really where we're heading now. This is kind of almost like a liquid. It's one of those trades that while the yen is weak, we're in kind of very good conditions right now for a potential move higher. In euro yen, especially if we see continued weakness in Japanese data compared with the slightly better news out of Europe. Once you get over 126, it does bring 130 into view. Between 130 and 135 is quite a big selling zone. I mean, just look at that. That triple top there, and they're kind of tweeter tops. 130, as we move towards 140, I know we're way away from that yet. there could be an awful lot of selling pressure on the way up kind of here. I know that's quite away from where we are, but it's worth looking at where these potential supply zones may be, especially if you're especially if you're you know, looking at some if you're looking at this from a longer term trade point. On a shorter term level, as you can see, it's still nicely pressing higher. 126, we would expect there to be some resistance, and then obviously, you know, the next kind of key thing to look at is going to be really is going to be payrolls and what happens with dollar yen. That's going to be the key driver of euro yen this afternoon. Okay, that is. Someone's mentioned 129 as being a key level. I mean, like 129 is actually the 100-month moving average. That is going to be key. But so is 130. You know, when you get to these levels, you know, there's an awful lot on the way up. So do watch out for that. But it does seem like, you know, as I said, the bulls are very much in favour of the euro. The bears are in favour of the yen. That is kind of unwinding. The euro-yen trade is an unwinding of those years of weakness in euro-yen because of that safe haven trade. So there's no safe haven trading anymore in the yen, and that's where we're seeing it in euro-yen. Someone's just mentioned as well, asked about any good books about correlations. I don't know any specific books specifically on correlations, like on calculations and stuff. There's a lot on the internet, so just type it into Google. You should get a lot up. Stock charts is also good. The other thing that I would point out in terms of correlations between markets, John Murphy's book, Intermarket Analysis, is a really good one. Okay, everyone, thank you so much for joining. Enjoy your weekends. Please, good luck trading, and we will see you hopefully next Tuesday. We'll see you next Tuesday. I'll be back doing things next Tuesday, but do watch out for those payrolls later today. Thank you.